Hi everyone, I'm here to talk about Chapter 9. I have a new tripod today, so hopefully this is going to work for me. First of all, I hope you have the Chapter 9 material for the video presentation, and we're going to be going over some homework problems as we do this. The first item is direct write-off method, and we're given an example. On January 10th, Bob Company writes off an uncollectible of $100 balance for A Company. So the way that's going to be done, on of course January 10th, we're going to debit bad debts expense for the 100, and we're going to credit the accounts receivable for A Company for the 100. I did note on there that this really is not acceptable for financial reporting unless you have an incredibly insignificant amount of bad debt expense. But this is an example of the write-off method, and I believe homework problem number 2, part 1, asks you to do something similar. So you can use that as a guide. Next, we're going to do the allowance method. Bob Company has a credit sale of $100,000 in 2011. And of this amount, $14,000 is still uncollected at December 31st. The credit manager is estimating 1,000 of these sales will be uncollectible. What's the adjusting entry to record the estimated uncollectibles? And also I put a note on there, bad debts expense is an operating expense on the income statement. Remember that. Usually it'll fall in as a selling expense, but just do remember that. On December 31st, our entry would be bad debts expense, 1,000. Our allowance for doubtful accounts is going to be 1,000. So we have a debit to bad debt expense, credit to allowance for doubtful accounts. Of course, each is 1,000. Something else I want to mention, your allowance for doubtful accounts is not closed at the end of the fiscal year. So I just want to point that out. Okay, now we're going to write off a 200 balance owed by B Company, and this occurs February 1st. So on February 1st, we're going to turn around and credit, because this is the same example, credit allowance for doubtful accounts. We have to get rid of it. It's no longer a doubtful account. It's gone. The amount is 200. And then we're going to go ahead and credit accounts receivable, B Company. We no longer want this on our books. We're not going to collect it for $200. I've just given you a little note to show you how before and after the write-off, your cash realizable value remains the same. Okay? After the write-off, the cash realizable value remains the same. It's just what amount is held as accounts receivable and what is held as allowance for doubtful accounts that changes. But it's really important to remember that your actual cash realizable value is going to remain the same. And you only write off accounts that affect the balance sheets. You're not writing off income statement accounts. Something else to mention. Okay, now, still looking at the same example, B Company turns around and pays the $200 that we had written off. So we've got to go in, reverse the entry, right? Now we've got to put it back on our books. We took accounts receivable off. No longer had a doubtful account for this. Got to put it all back on. So what we're going to do, and this occurs on February 1st, so he must have done it later, or excuse me, this occurs on March 1st. So on March 1st, we are going to reverse our previous entry. So go ahead and debit accounts receivable for B Company for the 200. Go back and credit allowance for doubtful accounts for the 200. And now what we're going to do is debit cash. We got $200, didn't we? Debit cash. and get rid of our accounts receivable. So we're going to debit cash for 200 and credit accounts receivable for B Company 200. Okay? So that's basically how we're going to do all of this. Okay? If you have any questions, go over this a couple times. If it doesn't make sense, if you have any questions, please contact me. But I'm going to move on to just recording some transactions that we're going to have. And some of these transactions are going to be similar to part of one of the homework problems. So let's go through them. Okay, first of all, on February 1st, Bob Company uses the allowance method for estimating his uncollectible accounts, and we're recording some transactions. On February 1st, sold merchandise to C Company for $1,000, terms net 30. So the net amount was due in 30 days. So at that initial sale, we're going to debit accounts receivable for C Company. That's $1,000. We're going to go ahead and credit sales revenue for $1,000. So that's something we've done before, right? We know how to do that. On May 3rd, we received a $700 payment from C Company. So again, we've done this before. We're going to go ahead and debit cash for $700, and we can go ahead and credit accounts receivable for C Company for that $700, right? They no longer owe us $700. The next question, what they do on July 6th, there is part of question 4. The beginning of question 4 is going to be similar to this. We're writing off an uncollectible balance for C Company. So we think the rest of it will not be collected. So we're going to go ahead, and I should probably put the dates here. This was 2/1. This was May 3rd. This is July 6th. So we're going to go ahead and debit allowance for doubtful accounts for that $300 and go ahead and credit our accounts receivable for C Company for that $300. We don't think we're getting it anymore. We think it's over. But lo and behold, on September 9th, we receive a check for $100 from C Company. We don't think we're going to get anything else, but we do get a check. And this is similar also to question 4, part 2 and 3, I believe. So we're going to go ahead and debit. Got to get the accounts receivable back on our book. We're going to debit accounts receivable for C Company for the $100. Credit our allowance for doubtful accounts for the $100. Now it's back on our books. Now we can go ahead and record the payment, right? So we can debit cash for the $100. We got cash. And credit accounts receivable C Company because they no longer owe us that $100. Okay, so and this should help you with part of question 4 also.